Hello, welcome to our option trading tutorial part 2. Today we're going to give some introduction on option contract. An option contract is just an agreement between two parties, which are buyer and a seller, over the right to sell or purchase of an asset. So the buyer of the option got the right, and the seller of that option have the obligation. So let's watch an example. Suppose there is a stock exchange and we have one buyer and one seller. Suppose the buyer thinks that the price of the stock will rise. He thinks the value of the stock will rise over 110, and the stock is currently traded at $100 per share. So instead of buying the stock directly, he can find a seller and tell him that he wants to buy a call option. The seller generally are not bullish on the price of the stock, so he can sell the buyer the option. So let's suppose the call option entitles the buyer with the right to buy the stock at a price of 110. And in order to get this call option, the buyer will pay the seller a premium, which is the price of this right. So let's see the case when the buyer got lucky, which is the price of the stock eventually climbed. So suppose the price of the stock had climbed to 120, and the buyer can exercise his call option, which is to buy the stock at the price of 110 from the seller. And you can see this price 110 is obviously lower than the market price 120. So let us see the profit and the loss from this trade. For the buyer, he paid the option premium at the beginning of $5 per share, and he buy the stock at a price of 110, and then he can immediately sell the stock at the market price, which is 120. And the total profit from his trade is $5 per share. And suppose he traded 100 shares, and the total profit for him is $500. And for the seller, at the beginning he received the option premium of $5, but when the option buyer wants to exercise the option, he has to buy the stock at the market price, which is 120, and sell it to the option buyer at 110. So from the stock trade, he lost $10 per share. Even with the premium he received, he still lost $5 per share. And if he traded 100 shares, the total loss for him is $500. So we can see the profit made by the buyer is exactly the loss of the seller. And we can call this trade a zero-sum game. And zero-sum game is very common in the derivative trading. So for the next case, we'll see when the seller got lucky, which is when he received the option premium for the buyer. The stock eventually fell, and in this case the stock price fell to $80 $10 per share. So for the buyer, he got no intention to exercise the call option at $110. He can instead buy the stock at the market price of $80 per share, and he will give up the call option. Let's remember that we had said that the option for the buyer is the right but not the obligation. For the buyer, he can give up his right, and for the seller, he can safely keep the option premium he received and generate a profit of $5 per share. If he trades 100 shares, the total profit from him is $500. So that is the tutorial today for the introduction of option contracts. For more information, please visit our website at quant.pobo.net.cn. Thanks for watching.